Hello and welcome, and we're out here with the KZN Municipal Pension Fund. Joining me as our guest is the Principal Executive Officer, Mr. T. Mketelwa, and also Mr. Lindsay Lofsted, who is the fund consultant. Gents, welcome.
Hello.
So just to kick things off, could you please elaborate on the difference between defined benefits and defined contribution schemes?
Thank you, Kznmpf. The funds in the country are actually defined benefits and also defined contribution. As you can hear the word defined benefit, your benefit is defined as you enter the door. How much and how, based on a calculation, will you get your money at the end. Basically, they will use a formula, which is final salary times years of service and the investment returns that you'll get at the end, which means whatever happens in that particular fund. And in a defined benefit, the employers carry the risk of fund poor performance. Whereas KZN Municipal Pension Fund is a defined contribution fund. And the defined contribution fund, the difference is it's defined by the number of by the percentage of contribution you have made and the returns you have made during your savings period, which means you've got a choice of contributions from 5% up to 18% of your salary that you can actually contribute. If you contribute 5%, you will benefit 5% plus returns. If you contribute 18% and be consistent, you'll get 18% lokuzana plus your returns. Therefore, you'll be better even if you have been earning the same salary. Depends on how you contribute. And the other issue, the risk is carried by the members on a defined contribution. How do we say the risk is carried by the member? It's because it's up to you whether how much you want the lokuzana to contribute, and the investment poor returns you have to take those risks when those investments are poor, but also when they're doing good, it's also not going to be contained by some particular formula.
So now, James, could you take us through the fund's investment process?
Yeah, so the investment process it really starts off with setting the objectives. So what happens is, originally when the fund was set up, the Board of Trustees would have had to decide what are we trying to achieve in this pension fund. Obviously, as the board changes over the years, we reevaluate this and we look at it. And every year the fund has what we call strategy days, where we also re-look at the strategy and we say, is it still appropriate for the members and what we're trying to achieve? But we start off with objectives, and the objectives are we want to try and invest the money in such a way that the members' money grows so that they can have a decent retirement when they retire one day. And so for that growth, we've identified that you need to invest in growth assets, which is shares, so local listed shares, shares listed on foreign stock exchanges, and property. Those are the things that grow, and then we add cash and bonds. And so the approach is, once we know what our objective is, we identify how much we're going to give to each of these what we call asset classes or investment opportunities, and then the trustees do what we call due diligence. We go and find asset managers. These are professional companies in South Africa and globally that every day of their lives, their job is to decide how much to invest in each of these opportunities, which shares to buy and sell, so that they can maximize the return for the fund, but also look at risk and protect the capital as best as they can. So we do the due diligence. They visit all of these managers. Locally, we must do 30, 40 manager visits a year. Globally, they must do 10, 15 visits a year. And we identify the best managers we think we can to do the job of investing in all of these asset classes. Once we've got the managers and we've got that together, we have mandates with them. These are agreements with these managers, telling them what they can and can't do. It's risk control, because we know the members, as Thomas says, carry the risk. So we don't want things to fail. And so what we do is we have strict, after the due diligence, we make sure they're real companies. Then we have strict agreements with them so that they can't make mistakes and they can't go crazy and buy futures or buy lotto tickets or anything. They have to do what they say they're going to do. And then it doesn't stop there. What happens after that is the board, every quarter, we have a full, call it monitoring evaluation of the performance. So we look at how did the markets do, how did the fund do, are we performing in line with the markets, are we performing in line with what the managers promised to do? And then lastly, we check, are we doing as well as all the other guys? It's fine to say we're doing what we achieved, what we wanted to do, we're doing okay, but if you're coming last in the race, it's not good enough. So the trustees then measure the fund's performance against other funds in the country. The average fund out there, they measure against very successful asset managers. And through that evaluation process every quarter, we can identify poor performance or problems. When we identify them, the trustees start the process again. Due diligence, who can we find that's better? Or we might give notice to that manager to say, manager, you're not doing well, you're not performing according to expectation. Then we cut their mandate, or we terminate them, and then we get new people. So I think that's the full circle. And then after the evaluation is done, after the performance is done, we communicate to the members and say, guys, this is what you've done, this is how much money you've got. And I can tell you for sure, if the returns aren't there, we get told about it by the members. You will hear complaints and people come to the office. When things are good, surprisingly, we don't hear from them. They don't come and hug us and pat us on the back, unfortunately.
Yeah.
But I think that's probably a good summary of how we go.
Yeah, just to add, there's also what we make a decision on, what we call the type of strategy. We can either go passive or we can go active, but we decide to mix those particular strategies where other asset managers are buying the shares and selling the shares all the time. And sometimes we also get asset managers that buy the index in the market. They don't necessarily buy one company, they buy just the whole index, or like a JSE, ALSI 40 or something like that.
So James, regarding performance, how is the fund doing in line with its investment strategy? And also, since in the past you introduced the alternative investment strategy, could you rather give us an update on the progress?
Should I do the investments and you can tell them about the alternatives, because I know that's close to your heart. So from a performance perspective, yes, there's ups and downs as we've all seen, but I think from a performance perspective, the fund has done very well, and the members can see it in their values. We were looking at it the other day. If you just go back 5 years, the fund has grown from 15 billion, that's a B, billion, all the way up to 24 billion. So 9 billion rand in growth has come through, despite paying benefits to retirees, to withdrawing members. So the fund has grown, there's no doubt, and the members that were in the fund have got much more money now than they did 5 years ago. From a performance perspective, because people don't understand percentages, but I'll say from a performance perspective, despite the fact that we've had this global cost of living crisis, interest rate hiking cycle locally and globally, the war in Ukraine 2 years ago now, Palestine-Gaza issue now, China and American trade wars, despite all of these things that have been happening, the fund has weathered the storm. COVID, we've even forgotten about COVID. Despite all of that in the last 5 years, the fund has weathered the storm, and the performance has been more than 10% per annum over the last 5 years. So what that means is it's like 10%, 10 times 5. So the fund has grown by over 50% in the last 5 years. I mean, that's a huge growth. And so I think, and that is because of that investment strategy that not only looks to grow, but also to protect us in difficult times. And part of the problem we experienced was when markets go up or down because of this volatility, shares that are listed go up and down together. But we noticed that with alternative investments, that's not always the case.
Okay. Alternative investments, it's nothing new. It has always been there, but we were lucky in 2022. Our regulators, in terms of Regulation 28, increase the percentage of alternatives like private equity, hedge funds and all that. And that gave us an opportunity to give a little bit more on alternatives. And secondly, we're living in a country where there's infrastructure, energy issues and all those issues. We then started seeing the alternatives as a real assets that we can point and make an impact in our communities, in our country. Therefore, alternatives, we have invested money in energy, we have invested money in infrastructure, and we have invested money in things like towers, where actually it's going to close the ICT divide that our people have been excluded in terms of technology, because certain areas don't have the their access to technology. Therefore, we like the alternatives, even if it makes a small percentage of our investment, because the stock market, JSE, hasn't been giving us great returns in the past 5 years. I think the average, Lindsay, if I'm not mistaken, was around about 5% growth that we've been getting from the stock market. And we've been getting better returns on the alternatives. Therefore, it's a diversity of our investment policy. And we actually, every year, in that strat plan that Lindsay talked about, we do review investment policy statement and make sure that we meet the objective of CPI plus 5, which we are always wanting our members to beat the inflation with the returns they've got.
If I can just add 2 things. So the nice thing about alternatives is, number one, it does the right thing for our country. It builds our infrastructure and it leads for everyone in South Africa to have a better life. The roads, when he says infrastructure, it's roads, it's ports, it's water and sanitation, it's electricity, it's all of those good things. So it does the good thing for our country, number one. But number two, the returns are good. It achieves inflation plus 5 per annum. And the last thing about it, what's nice about it is it's less volatile. It doesn't go up and down very quickly because, as Thomas says, it's a real asset. It's a building, it's a dam. You can point at it, and whether the markets go up or down, that thing is still there. It's still got value. And so what we find is when the markets go down, it holds its value. And when markets go up, it might not go up as much, but that's the point. We want it to be there, to be that protective element in the portfolio. Yeah.
Some pretty interesting points. Thank you so much for your time, gents.
Thank you.
Thank you.
Thank you.